Well, that's it, folks. Uncle Trudy is officially coming for your hard-earned dollars in another way. As the federal budget that was announced for 2024, Justin Trudeau's Liberal government has announced that they are going to officially increase the taxes on capital gains for the first time in 23 years to make life more fair, is what they say. Do you believe that? I'll leave that up to you. But at the end of the day, they're making changes. The changes are here to come. There's a heck of a lot of confusion about what these new capital gains taxes mean and what capital gains taxes are. I've heard everything under the sun, and I'm going to try my best to dispel some of the myths. Remember, I am not an accountant. I'm a mortgage broker, but I have done some research, and of course, I'll make sure to provide you with some information that you need to know when it comes to figuring out what this all means to you. Welcome back to the channel. Let's get right into it. What the heck is this new capital gains tax, and what could it actually mean for the marketplace? Who's it going to impact? And more importantly, let's give you a couple of examples so you know exactly what you're looking at. Now, first and foremost, capital gains taxes are taxes that are paid on the profit or proceeds of an investment. In this situation, we're talking about real estate specifically. Now, typically and up until today, capital gains taxes were paid and charged on 50% of the profit of a property. There's a common misconception right now that capital gains tax rate has increased to 66%. That's not actually what's happening right here. So let's break it all down. How this all works, let's use an example of a property that is $800,000 today that was purchased for $300,000 10 years ago. If that property is an investment property and it's gone up in value from $300,000 to $800,000, there's a $500,000 gain in the property, which is profit. Now that profit is taxable, depending on whether or not this money is held in a company or the property is held in the company, or if it's held personally. There's two different changes that you need to know about. Let's stick with the basics right now. Up until recently, and up until June 25th of 2024, capital gains were taxed at 50% of the profit. So in this situation, if you made $500,000 in the property, 50% of that amount, so 250 grand, was eligible to be taxed. Now the taxed amount is dependent on your tax bracket. So if you have a look at your tax bracket, if you pay 30%, 35%, whatever those numbers are, those tax brackets are how much taxes that you pay on that 250 grand, which is half of the 500. After June of 2024, what's actually going to happen is now you're going to pay tax on up to 66% of that amount instead of $250,000. But here's where things get a little bit more interesting. If you own a company and you own the property in a company, like an investment property, a lot of investors have these, or families who are selling investments have these companies where they hold these assets, you are taxed at 66% of the entire profit day one. But if you own it personally, you are taxed at 50% for the first 250 grand and 66% on the remainder. So in the example we shared with you, there's a $500,000 profit. So the first 250 is taxed at 50% capital gains, with the remaining 16% taxed at 66% of that amount. I've heard a lot of people say anything and everything from you're going to be taxed on the entire amount to the tax amount is 66% to the tax being 50% to there's 250 grand. But that is not the case. This is exactly how it works. So with these new changes in place, what you need to know first and foremost is this is going to have an impact in the marketplace. There are going to be people out there who don't understand this, or maybe some that do, that are going to be rushing as quick as they can to try and offload investment properties, secondary homes, cabins, whatever that might be, before this June 25th deadline comes in effect, which obviously could mean, and we're starting to see it already, less rental properties available after the fact, because people typically who are buying them might be buying them for themselves. And while you think that could be a good thing initially, and I don't disagree, it's a good thing to get the market churning, what this is actually doing is having a negative impact on the rental market and the housing market as a whole. In addition to that, once this June 25th rule goes into effect, the new capital gains, this will de-incentivize people from selling properties. Therefore, after this price point, people will continue to hold these properties as long as they can and probably just end up refinancing them to pull out the equity, because you don't have to pay tax or additional tax on the refinance from the equity of those properties. But remember this, at the end of the day, while the government is suggesting that these particular rules are meant to rob the rich and give to the poor, like a Robin Hood thing, it's actually negatively impacting everyday families that they're said to be trying to help, because most mom and pop investors are the ones who have this saved up for their retirement or who are saving for their retirement. What this will probably end up doing in the long run is negatively impacting investment in our economy in so many different ways. An example would be, first and foremost, we're going to see lower adjusted tax returns. So you're going to pay more tax in any investments. And what this is going to do is it's actually going to increase the cost of capital. If you think about it from a developer's perspective or someone purchasing any real estate as an investment, they're probably not going to not purchase it and not do the development, but because the rate of return is lower, they're going to charge more money. And their investors are going to demand a higher amount. And what this is going to do is, in turn, it's going to make it so that they have to increase the cost of these assets or the rent of these assets, depending on if it's a for sale building or if it's a for lease or rent. These costs are only going to go up as the costs are passed along to the developers and the investors. And everyone really, at the end of the day, is just going to pay more tax. So again, I ask, who is this really helping? Another negative impact of this event could be foreign investment. We have a higher capital gains tax than virtually every state in the United States now. So why are people flocking to Canada to invest, knowing that our costs have gone up so substantially? This will end up having a negative impact in the economy that's already suffering as a whole, and at the end of the day, provide less of a reason for people to come to our country. Of course, it'll kill jobs. It's going to hurt jobs because if there's less money to go around, who is actually getting these jobs? I guess those recent stats that we saw about less and less and less self-employed people in our country make sense now. They're all getting hired by the government and working jobs for the government, and they're unable to continue on self-employed because the taxes are absolutely killing them. Think about things like doctors. Most doctors get paid into a corporation. That's how they avoid having to pay, $500,000 of tax per year. And we need doctors. So by doing this, we're having a negative impact on the likelihood to have people come to our country and attract them to our country because we're taxing them to death. And it's the people that we need the most, in this case doctors, that we're actually saying, hey, don't come here. We're also discouraging investments into rental buildings and other types of buildings that we actually need. So I ask you again, what is the benefit and the purpose of this tax, if nothing else than to add another tax that's supposedly supposed to be taxing and giving back? I don't want to get into the carbon tax right here, but it seems very similar to that. What's the good news? Well, the good news is that if you own a primary investment, a home yourself, you're not going to be taxed on your home. Thank goodness. You're not going to be taxed on the principal gains. The second thing is, I guess you have that $250,000 exemption if it's in your personal name. If it's in your company name, that's unfortunate. I guess the third good thing is, it's probably not as bad as you really think it is if your capital gains is a few $100,000. But if you are a business owner and you are selling assets that are worth millions, I'm sorry about that. And it's going to definitely hurt. It's definitely going to sting. At the end of the day, I don't want to make this too political, but if our number one goal is to build supply, sustainable supply, and promote building in our country sustainably, why would people continue to do so when all we do is get taxed and regulated to death? If you found this information good, leave a comment below. If you found this informative, leave a comment below and hit that subscribe button. If you have any feedback on the taxes or anything I missed, leave it in the comments below. I'd love to hear from you. Make sure to hit that subscribe and that alert button, and I'll see you on the next one.